Welcome to 7 Investing Now, a show that teaches you how to take a long-term view on investing by better understanding what's happening in the market now.
Wow, good afternoon, 7 investors, and I am not coming to you from a dungeon. I am coming to you live from Birmingham, Alabama, and not to be too technical, this is, of course, 7 Investing Now. My name is Daniel Brooks Klein. I am very excited to be here. That being said, I have a really fancy camera that fixes the light, and we just got off our members-only call. I couldn't use that camera because my Mac only has one port, and I need to plug in my battery so my computer doesn't die. And I went to plug the camera back in, and it isn't working. I don't know why, so I'm going to be a little darker than expected. But I am being joined today by much of the 7 Investing team. We're going to go around the horn in a bit, but I wanted to introduce what we're talking about. We're going to talk about how we decide to buy a stock for our personal portfolio. So it's sort of going to be everyone talking a little bit about their process for putting a stock on their radar until they actually pull the trigger. Then we're going to take some of your questions, ones we got on Twitter and ones we got live. Then we're going to talk investing mistakes we wish we could have back. We're going to try to get all that in and not have that long a show because we're all tired. I don't have any coffee, which is a giant problem at loft hotels if you happen to be watching. But before we get serious, I want to introduce everybody with something silly. And I would like you to share yours in the comment. Matt Cochran, what is your go-to summer food?
Anything you can put on the grill, right? So, like, as long as I have a cold beer in my hand and I'm out by the pool and it's on the grill, like I'm pretty much good to go right there. But like, I mean, like I can be easy, like burgers, or it can be like smoking ribs. But if I'm grilling meat on the grill by the pool with a cold beer in my hands, I'm good to go.
Simon Erickson, your thoughts on your favorite summer food. And again, wherever you're watching this, feel free to share in the comments what it is you're eating this summer.
I choose Dos Equis as my answer, Dan. That's my favorite for the summertime down here in Houston. Great answer by Matt. Put it on the grill. But personally, for me, it's Chipotle, which they've just opened near our house, and I'm very excited about.
Dana Abramovitz, your thoughts here.
Sorry, my internet wasn't great, so I didn't really hear the question. I'm guessing it's what I eat and drink during the summer.
Yeah, we're talking favorite summer foods.
Cherries. So it's cherry season right now. It's my very favorite fruit. It only, like, you just have this little narrow window, and that's really all. And baby carrots.
That is not one I expected. Steve Symington, your thoughts here.
I'd go ribs on the grill, Traeger specifically, which is going public, I believe, with the ticker Cook, right? So that should be an interesting company to look into. But yeah, definitely ribs.
Steve, do you own more than one grill?
I do.
that is very impressive. Matt Shatsko, your favorite summer food?
I'm going to go with watermelon. Me and Dana, we know how to be healthy, unlike all you slobs. And, that's just watermelon. Great summer food.
You're all wrong. The answer is lobster. If you've ever been to New England, it is lobster season. Lobster is relatively inexpensive this time of year if you're in New Hampshire or Boston. At some point, we'll all get up to my family house in Jaffrey, New Hampshire, and I will make lobster. You can grill lobster. So Steve's answer technically could count there. But we're going to pivot a little bit, and we are going to talk about how we pick stocks for our portfolio. It's different for everybody. And I'm going to start with Max. I'll go in reverse order here. So Max, Steve, Dana, Simon, Matt. Max, how do you put something on your radar, follow it, and then eventually pull the trigger to buy it?
Man, so I start off with interesting, technical areas. I don't actually start with companies. So I take a bottom-up approach to investing. So I'll nerd out on some interesting new approach in drug development, for instance, or maybe even in energy storage or something like that. I'll read through the scientific literature. Maybe I'll talk to some scientists or companies, startups, whatever it is, to try to understand all the challenges, all the opportunities of that specific technology, what the markets might be. Then I look at the competitive landscape, and eventually, after you understand the challenges and the opportunities, a couple companies will bubble up to the top. And I'll look through those. That's where most people start, maybe, right, with their research. But I'll dig through the SEC filings. I'll understand their finances, their business model, their commercial strategies, and drug development, their development strategies, maybe their technology platform. What are the unique advantages of it? And then I'll, maybe narrow that down further to 1 or 2 or 3 companies, and really, do a deeper dive into that research. And sometimes I don't actually invest in any of them after all of that. So I don't try to force it just because I think an area might be interesting. Sometimes there's just nothing that's to really capitalize on. But that's usually how I go about picking companies. It's a very long process. It takes months. Like I'm researching companies now that might be recommendations in early 2022. So it takes some time.
Max, how many stocks are on your radar?
Ugh, how many stocks are on the stock market? I don't know. Like I honestly have like over 100, a couple hundred maybe. Yeah, several hundred. But I organize them in different watch lists depending on the area. And I'm a nerd, Dan,
We'll get to Steve next, but a few of you shared your summer foods. Sloth Investor says, chicken with white wine. We sloths like chicken. He also points out that his wife is half French, so watermelon is very big in France. I did not know that. That is a learn something every day. Glenn Kramer, potato salad. Also Glenn Kramer, happy birthday. I believe today is Glenn's birthday, if Facebook is correct. Mike Fee says corn on the cob. I fully agree with that. If you're in New England, in Florida, that is not a go. Corn on the cob needs cold weather to grow properly. Steve Simonton, I'm sure you've got something on the grill now, but how do you identify stocks for your portfolio?
I don't have anything on the grill, sadly. So identifying, I guess the process for adding and identifying, I mean, I've got a watch list that any given point usually has 50 or 60 stocks I'm really interested in. There's a lot more that are on my radar, but I'll narrow it usually to all the top kind of revolving 5 or 10. But I'm looking for kind of big picture opportunities and kind of the businesses that are earlier in their growth stages of potentially, disrupting large markets or maybe carving out new markets altogether. And it takes some time, like Max said, to determine. I don't find a stock and immediately decide to add to it. And there are some cases where a new IPO might pop on my radar, and I'll add a small position just so I'm watching it. But that's another thing to keep in mind is once I have found the companies that I'm really interested in, and those of you who followed me over the past several years kind of know the kinds of stocks that I tend to enjoy. A lot of your kind of high growth disruptors, very volatile. But in part because of that volatility, I seldom add a full size position all at once. I'll kind of average in over the course of maybe several quarters, and I'll do it in thirds or quarters of what I really wanted to put into that stock to begin with. So, I seldom just say I'm putting this much money into this stock right now. I'm patient about the way I do it. And that way, if the stock climbs, I'm at least participating partially in those gains. And if it pulls back hard after I initially buy, even from a valuation that I deemed attractive at the time, at least then I can kind of dollar cost average my way in. So, I start small, I'm patient, and then I'm flexible as I add.
Everybody has different methods. And of course, in honor of Glenn Kramer's birthday, later on, Max will be eating an entire cake by himself. Dana Abramovitz, you do things a little bit different than the rest of us. You come to the market from a different perspective. I'm curious, how do you decide when and what to add to your portfolio?
Well, so I'm also a nerd, but like just a healthcare nerd. So every time I see something, read something, hear something in the news, I'm thinking about it with that healthcare lens. Like that's just the way my mind works. And so, I'm constantly, different things come on my radar because of the way that I'm looking at things. And so, that kind of helps, pin me to, a new industry or, a technology space or something that's happening in healthcare. And so then I kind of start focusing in on that. The things that I look more, qualitatively, so who is the team, what are they doing, what is the market, looking more holistically at the company. And then, if I like the things that I see, then I dive into the financials. So I'll read all the SEC filings and kind of look and see, are the things that they're saying, on the surface making sense with, their financial statements. And if those things match up, then things kind of go from there.
We very much appreciate that, Dana. We also appreciate all your questions and your comments, the interaction in the chat. The next segment is going to be kind of open questions. We've got a few we took from Twitter, but if you have anything you want to know about the market, if we can answer it, we will answer it. If you want to know my impressions of out my window in Birmingham, Alabama, which is literally all I've seen so far in my visit here, I'm happy to share that with you too. Simon Erickson, do you just throw a bunch of stocks in a bag and then mix them up? How do you do it? What is your process here?
Dartboard, Dan. Almost the bags. The dartboard is what I do.
Max would be cheating if he did that. He's good at darts, so he could pick which stock to hit on the dartboard.
That's why he picks the best stocks. He's the best darts player of the team. Max did mention that he's a bottom-up investor. I would say I'm a top-down investor. I spent my 20s as a direct sales rep, kind of going out and seeing these trends that were taking place. And then just more recently, I spent every month of a 4-year period going out to technical conferences, right? And so I'm this relentless note taker that's always jotting things down. Everyone on the team knows I'm always writing something down and organizing it later. I tend to look for kind of where are the trends that are developing out there? What are the ones I want to invest in? And then which are the companies within those trends that I think are the best opportunities? And if you look at my last 2 months recommendations, it's followed exactly that same strategy. And I think that this upcoming month is going to follow the same one as well.
Simon, I don't want to interrupt you here, but I just got a call from my friend Scam Likely, and he said my extended warranty on my car is going to expire. It's not the car I own now, but I still think I probably have to leave the program here. No, just kidding, of course. Again, why are we doing this today? We're doing it to show that we all have very reasoned approaches, but we do it differently. I know that in a lot of cases, the way I do it is I experience something. So, wow, I have an experience. I go to a restaurant and I go, wow, that restaurant was great. Like, I think this is really, this could be an expanding concept. I wonder if they're public. And if I look and find they're public, then I start digging into the financials. And sometimes a business you really like is not in great shape financially, or doesn't have great management, or has other problems that make it not a great investment. Not every stock I own starts that way. Of course, it can't be, but a lot of them have. Matt Cochran, I am guessing you do it. You know what? I'm not even going to make a guess. How does Matt go about picking stocks?
Well, I mean, I'll look for ideas anywhere. That can include in real life. That can include like with products I use, or stores I'm going to, or services I'm using. It can include for, like, a lot of times I get ideas from the rest of the team, right? When we pitch ideas and bounce ideas off of each other. I mean, not Max, but everyone else. Like when I look at a business and I get interested, like I want to understand what makes it special. Like what differentiates this company from its competition? Why does this company have an advantage? So I want to look for a company's economic moat, or just like does it have a sustainable competitive advantages against its industry peers? And once I get that, like, even as I'm studying it and I start to get really interested, a lot of times I'll take a small position, and those small positions, you can call them starter positions, you can call them lots of things, but like as I study it, I can sell those pretty quickly. Like I don't believe long-term buy and hold in these really small positions, but as I learn more and I start to like it more, I'll just keep adding to it, and over time just build up positions that way. I like to take small bites out of things. That keeps me from a lot of times being my own worst enemy by taking these small bites. If I told myself I would have to take a 5% position right away or something like that, a lot of times I would just chicken out and not buy something, and I'd be even more conservative than I normally am when picking stocks. So taking small bites allows me to be a little bit more aggressive than I would normally be, and it allows me to act a little quicker. But like I said, like as I continue to study, if I don't like it, I do sell those small positions. So I do have a lot of churn with those small positions. But other than that, I just want to know what makes a company tick, what makes it special.
We are going to seg into taking your questions. But before we do that, I will point out, Matt mentioned talking to other advisors. I have a stock that is on my radar. Could be my pick next month. Not gonna name it, of course. And my thinking on that got crystallized by a very long Slack conversation with Matt. And that's happened over dinner. That's happened in our Slack channel, where I had a company I liked, and there were maybe mental roadblocks as to why I wasn't going, and I don't want to say all in, because it's not like I'm putting all my investment, but making an investment in it. And Matt helped me really figure that out. Simon, we are in the middle of the month here. We are 2 days past Bastille Day. It is July 16th. That makes us about 2 weeks from the first of the month. What happens for 7 Investing members on the first of the next month, of every next month? Because there's always a next month.
Yeah, that's right, Dan. So we all talked about our different approaches to picking stocks. We're actually going to open the floodgates on the first of the month and release our top stock ideas. That's when our recommendations go live for the upcoming month. That will be August 1st, that we publish our top 7 ideas in the stock market. Everybody picks their top idea. We put them together into reports and we email those out to all of our subscribers. So it's always a great time to join 7 Investing, see our top ideas out there.
If you would like to become a subscriber, you can join 7 Investing for $49 a month, or, and this is where the deal comes in, $399 a year. That is very, very simple. You can go to 7investing.com/subscribe. And of course, if you're already a subscriber, if you go to your account page on 7 Investing, you have a referral code. Many of you are subscribers because we just came off our subscriber call, and I'm sure many of you followed us over. Tweet out a referral code and tag some of the 7 Investing team, or tag at 7 Investing, and we'll send those out. We want as many people to join our tent as possible. For every person that joins with your referral code, you will get 1 month for free. Now we're going to seg into taking your questions and comments. Then we're going to move into investing mistakes. I say we, but it's really you because you shared them on Twitter. But first, we're going to start with a fun comment from Mike Fee. Mike says, Max, I played a charity round of darts against Phil Taylor, arguably the best player in the world, and got crushed. I know, Max, I've let my subscription to Darts Illustrated lapse. That's a mistake. Is Phil Taylor the best dart player in the world? I assume this is also not Phil Taylor, who used to run FinCon. Probably a different guy.
Yeah, Phil Taylor. Everyone knows Phil Taylor, the darts player, right? You guys don't know. He's like the Tom Brady of darts, right? Right. So there's actually, if anyone wants to like just joke around and look on YouTube, there's something called Phil Taylor versus Japan. And he just went there for like an event and played all the best players of Japan. And I think he lost like 1 game. So like, it's just ridiculous how good he is, or was. I think he might have retired, but Phil Taylor's awesome. I have so many questions, Mike, but we can follow up after this.
It's summer. If you're playing lawn darts, be careful. Those can be very, very dangerous. Stuart chimes in with the live question, and we would love your live questions and comments. And guys, whoever wants to comment, raise your hand. I'll call on you. We didn't really organize this out, but Sam, if you want to share that comment from Stuart, that'd be great. How do you handle opportunity costs, especially when trying to select your best investment idea? This one is absolutely a challenge. Nobody is raising their hand, so I am going to throw it over to Simon, who did just raise his hand there.
I mean, we kind of all look at different things on that. So it's a personal question on how you approach it. I will say, Stuart, that most, at least the advisors that I know on this team, most of us start with a list of between 20 and 25 stocks we're looking at every single month, right? So it's not just like, oh, we're just going to go with this pick this month, or, oh, I've got kind of a gut feel, I'm going to go with this. It's a very intensive process. I think part of it is valuation. You know, is this the right time to get into a position for a company like this? An even larger piece, at least from my personal perspective, is performance of the business, right? Is this a company that is knocking it out of the park and is going to continue to do so in a way that is not appreciated by the market? That sounds verbose to say it that way, but when you look at kind of, you know, earnings or cash flows or revenue growth, I mean, the fundamentals of the business, when you invest long-term like we do, are the drivers of long-term stock price returns. We talk about valuation a lot, but really, can you find a company that can grow revenue for 20 or 30% for 5 years or longer? If you can, that's going to be a pretty good stock pick over periods of time. The market will adjust the valuations that it wants to give along the way. But if you're going to think long-term and hold on to a compounder like that, that's where you really can make some great fortunes in the stock market. So those are the kind of opportunities I look for.
Yeah, I try not to worry about opportunity cost. I view it this way. You're going to make a lot of choices in life. And if you spend all your time going like, oh, I'm married and I'm happy and it's good, but like, wow, that cute girl in 8th grade, what if things had worked out with her? You're wasting a lot of time. I'll give a quick example. Like in August, I have to decide between a Vegas trip and a week-long cruise. Whichever one I do is going to be a good choice. I'm not going to be on that trip going, oh, if I'd only done the other one. And I know that can be hard with stocks because you buy something and it goes up 200 or 300% over 10 years, and you didn't buy something else that goes up 10,000%. Just remember, it can go the other direction too. So, you know, make your convictions. And look, if you really, really are torn, buy a small position in both. That is not crazy to do. Sam, we're going to go through the questions in the doc in order. And if anyone has any more live questions, we're happy to pepper those in. But let's take the one from Bradley Smith on Twitter here. With Bezos now transitioned out of the CEO role, albeit not too far away, Should investors be concerned with this move? I just want to make one comment on this. Everybody reports on this as Bezos stepped down. You've all heard me say this. Bezos stepped up. He didn't leave the company. He went from being the CEO to being the executive chairman. Executive part means he still works there. Chairman means nominally he's kind of the CEO's boss. So I think that is important to remember. Matt Cochran, I will let you take this one.
Yeah, so like it's just important to know, like Andy Jassy joined Amazon in 1997 straight out of business school. This is the only company he's ever worked for since graduating business school. That was also the same year Amazon went public. And Bezos first noticed Jassy at they used to take some teams like to this lake house, and they were played like this like broom hockey game or something like that. And Jassy checked Bezos really hard, and that's actually like the first time like Bezos noticed like Andy Jassy. And in 2002, Jassy was selected to be the first shadow advisor to Bezos. So this basically, he became Bezos' chief of staff and followed him around the entire year, going to every meeting that Bezos went to and everything else. And then at the end of that year, he pitched AWS to Bezos. He basically said, like, look, we have this troves of e-commerce data. We have data centers around the world. We can offer these services to other companies, making data storage and analysis and analytics a lot cheaper to these other companies. And Bezos signed off on it, and Jassy was in charge. And he has been in charge of AWS from 2002, 2003, when it was still this, like, basically not more than a memo, to building out to what it is today, the largest cloud service in the world, responsible for 50 to 60% of Amazon's operating profits. And it's kind of like when Microsoft appointed Satya Nadella to the CEO. Like, Nadella came from the cloud side, and Microsoft realized like this is the future. And the same way, look, Jassy's coming from AWS. He knows the future of this company, and also culturally, he just fits in. Like I said, this is the only company he has worked for his entire life since graduating business college. So I think he was the obvious choice for Amazon to make here. And I think Amazon's in good hands.
So Max, let me throw out the lesson I learned from this. When we have our first 7 investing advisor meeting in person, maybe it's Montana, maybe it's at Simon's house, who knows? Taking that seed, you have to walk up to Simon and punch him in the face, because you want to get on the radar like Andy Jassy. That is, of course, a joke. Only do that if we're playing basketball or something.
I would recommend against that, Matt Cochran.
We are going to move on to the next comment, and that's our very own Brock Briggs, a friend of the family. Would love to get each team member's view on being fully invested or holding some cash, and if that changes based on where the market is. I will go around the room in reverse order, but I'll start with myself. I put money into my investing account every other week, but I am not unwilling to move money in from my checking account if I see a unique opportunity. Maybe something I'm following has dropped 50% because of something really dumb, or so I always have money available, but I am lucky to be in a position where I have a really solid emergency fund and have money on hand. Max Chatsko, how do you go about it?
Yeah, so Brock asked, just to recap, are you fully invested, or do you have cash in your portfolio at all times? And I think on paper, it always sounds nice to have cash in your portfolio, but in reality, it's a little impractical. Like, you can never really time the market, right? It's always nice to think, well, when the market goes down, or that stock I really like goes down, I'll have money available. And I just find that doesn't really turn out that way. And look, if you had a lot of cash in your portfolio in the last year or 18 months, you missed out on a whole lot of gains, right? So that wouldn't have worked out for like waiting for the stock market to drop. I mean, I think like things are a little frothy, right? Like, and certainly historically speaking, but I'm still fully invested. And if I was sitting on cash thinking like, oh, everything's overpriced, I would have been kicking myself right now. So same thing as Dan, I put money in every month. I kind of know what I'm going to buy ahead of time. I have like certain target allocations across my positions that I try to have on like a rolling basis at least. And sometimes I do move money around if I do see a nice opportunity, but yes, usually like close to fully invested.
And Dana Abramovitz, we know you have other questions, so we're going to let you say goodbye to the audience here at 7 Investing Now.
Yeah, sorry guys, I got to go. Yeah.
No problem. We'll see you later. It is a busy world. It's summer. There are lots of things going on. Simon Erickson, are you fully invested, or is there money under the mattress at home there?
Yeah, what Matt said earlier, I think is kind of the approach I take too, which I always like to buy a small stake at first and then add to it over time. And everyone's got kind of a different definition of, is that a 1% stake of your portfolio? Is it 2%? Is it $100? Whatever your definition of small stake is, I try to keep enough cash always in the portfolio for at least one or two small stake new positions. Just so that when there's an opportunity, I mean, sometimes those go pretty quickly. If you've done the research and you know that that's a company you want to buy, and then it goes on sale, I don't want to kick myself that I missed that opportunity when the window was open. And so I'll typically have at least enough cash to cover two small stake positions that I would want to add over time.
Matt Cochran, always keep a stake nearby in case of vampires. That is very, very important. Matt, how do you go about doing this?
I try to add money whenever I can. At the beginning of the year, like I max out the retirement accounts for the year. And I also try to add every month. I'm always trying to put cash in. Look, like I shared, like this morning, like I had to pay for two kids to get braces this month. So this month it was definitely less than it normally is. Right. But and life happens. So I can't say it happens every single month, but like almost every single month. And especially at the beginning of the year, I always try to be putting money in my accounts.
Matt ignored my suggestion to let one kid fix the upper teeth, the other one, the lower teeth, and then sort it out later. Probably go with the dentist's advice, not mine. We appreciate your questions. We appreciate your comments. We are going to move into the home stretch. And this is something we like to do a lot. We are very active on Twitter through the @7investing account and through our individual accounts. And we'll throw questions out there and sort of ask for things. And some of them go pretty viral. So what we're sharing today is a pretty small percentage of the answers we got. But our question was, which financial mistake do you wish you could have back? There are a lot of them. I'm going to have Sam throw them up and then let everyone jump in as they can. Sam, feel free to just go in order and throw the first couple up here, because I believe these two, even though I bought my first stock at 19, I've started my kids today. Yeah, that's an important one. Steve, when did you start investing for your kids?
Just a couple of years ago, actually. And they're young, but I wanted them to be able to understand kind of what is happening, what they're doing, what they're buying, and I want them to be able to see it. And actually, they have stockpile accounts, which is pretty handy because they actually allow you to have this custodial system where I can control. I have control over approving what they have, and they just announced that they're doing away with the 99-cent commission thing. It's all free commissions now. It's stockpile and partial shares trading, which is nice. But yeah, I mean, my kids are 6, 10, and I had to think because his birthday is next week. And I was like, wait a second. So 6, 10, and 13. And so I mean, to be able to get them started really early, and I mean, not necessarily doing the full due diligence process, but I'll kind of use it as opportunities to kind of have them understand how revenue works and what net profit means and what margins are and owning the concept of owning a piece of a business. But you start early, and it's fantastic to kind of watch them. I don't want them to be intimidated when they're older, and they sure won't be by that point. So that's nice.
Yeah, I'm going to throw to Simon in a second here, but I'll say my son is 17. He's interviewing for jobs as we speak, and I've told him half of what he makes will go into a stock market account that I will work with him on. I will probably even up it by making it like a 401k, where for every dollar he puts in, I'll put a nickel into that account as well. He already has an Acorns account that my brother funds that he doesn't get till he's like 25. So he can sort of in a gross sense see how things works. But I want him to understand individual companies. He's interviewing at Wendy's. I'm going to have him buy a share of Wendy's stock, even though that's not a company I generally recommend, because if you work someplace, it's a good idea to have a stake. Simon, you have the youngest child on the team. Are you doing like investing picture books? Have you talked about this stuff yet?
529 plan. I mean, college plans. I mean, everything that we said are great examples of building a process. And stock market does not have to be, you go at it on day one of investing, you put your life savings into one stock and hope that it works out for you. I mean, a little bit here and there added up over decades is going to make a huge difference. It sometimes is hard to do that in large amounts. It's much easier if you just get into a process of putting a little bit away every single month. So I really like what both Matt and you and Steve and Max, we've all mentioned so far.
Robbie Shaw, we see your question and we'll get to it before the end of the show, probably right before we hit our finisher. Sam Bailey, throw the next one up there from our active Twitter audience. Neeraj Kapoor says, started investing too late. This was overwhelmingly the number one answer we got. Max Chatsko, you're the youngest member of the team. You might also have started investing the earliest. How soon did you start investing?
Yeah, I got into investing actually during the great financial crisis. So I was 19. It was 2009. And I guess I just gave away my age there. And I was still in college. I was a sophomore in college. And that's when I really got into it. Made a ton of mistakes. Bought a bunch of terrible companies initially. But you learn the ropes and you try to evaluate your mistakes and learn from them. And, now I get to do this for a living. And I mean, I went to school for engineering, right? I didn't go into finance, but I get to do this now. And I, cover areas of the market that maybe a lot of other people don't understand. So I'm still applying, my training. So yeah, you can, starting early is great, but you really can't start too late. Any time you start is good, so don't kick yourself too much. There's never really a wrong time to start.
No, there is no too late. I didn't become a serious investor until I became a financial journalist, because I think kids have more opportunities to understand the market and things like zero commission trading. And it's much easier to trade than when I was 25, where I made all those dumb mistakes and chased penny stocks and did all the things that anyone young does. But when I started working and curating financial news over at Microsoft, that's when I started seeing stories and going, oh, wait a minute, why am I not doing this? And look, that is fine. If you're 50, that's great. Start now. If you're 62, you might buy different things, but absolutely start now. Let's take the next one here. We'll try to work Matt and Steve in as well. Bought Tesla 12/14/2010. Sold Tesla, oh boy, 2/7/2011. $1 million mistake. I own it again now, but the difference is palpable. Yeah. How many people do we know that sold Amazon like $3,000 too soon? Or I don't know what trades at, but a lot of $1,000 too soon. Steve Symington, I know you lament any share you've ever sold of a company that's up. What are your thoughts here?
Right. That seems to be a lot of people's biggest investing regret, is selling companies too soon. Right. And there are, I guess I'll sell positions of companies if I need the money. Right. And I remember telling the story about how I sold kind of evenly across my portfolio to clear up some money for the down payment on my house that we bought in 2015. And one of the stocks that I'd actually sold, which I still own a small position in, but was NVIDIA, which I bought about $8 a share, I think $8-9 a share, somewhere in there. And I sold, it was almost 300 shares of NVIDIA back in 2015 at about $21 a share, I think. And now what is it, 600 something? It's absurd. So I mean that would have been a pretty hefty. That would have more than covered the down payment on my house by itself. And but it's kind of a shoulda, coulda, woulda game for me, right? And I bought Tesla in mid 2019 and sold a small portion of that after shares had tripled, and that was a split adjusted $40 a share again. It's sort of, you kick yourself and you think, these are the merits of buy and hold, and nobody can continue to time the market, and you tend to price anchor based on old, if only I'm hesitant to buy it back now because it's $683 a share right now. And that doesn't mean it can't climb higher. And that's just something that I think people need to learn is just hang on. And go.
Steve, even back when they gave you physical stock certificates, when you bought a share of stock, you couldn't sleep in them. So selling shares for the down payment on your house, which, by the way, might not be up as much as NVIDIA, but its value is up quite a bit too.
Right.
So I think it's really important. We don't invest just so we can say we're winning and then we die and our kids inherit it. We're investing because we have goals. Like we've talked about this on the show. I just bought an investment property. That was one of my lifelong goals, that I wanted to own in a resort that I could both use and rent out. I will happily say, for every day I'm not using it in July, it's booked. So I bought this property that we scrimped and we did everything we could possibly do. I don't lament the stocks I didn't buy because I bought a place where next week's show I'll be doing it from my patio and then going to the pool. Like, I think that's why we're investing in the first place. Sam Bailey, bring up the next one. Thank you, Sam. Had the mindset earlier in life that investing was for wealthy people. Thank you, Warren Chapman. Matt, you did not come to this as a wealthy person. You started investing, I believe, when you were enrolled in the military on active duty. And I'm going to guess, I don't know how military salaries work, but you weren't wealthy back in those days. I think that's probably fair to say.
No, I was not wealthy back in those days. It was actually right after I left the military when I started investing, and then unfortunately, or I sold all my stocks to put a down payment on a house right before the housing bubble. So I made like lots of great decisions early in my investing life. But like, no, look, I mean, the stock market it's the greatest wealth creator that we have as a vehicle, for wealth creation, besides maybe entrepreneurship and starting your own business. But like, for most individuals, like the stock market, the American stock market specifically is like the greatest wealth building tool we have. And if you want to become wealthy, you got to participate in it. It's not just for wealthy people. It's for people who want to get wealthy one day.
The stock market, entrepreneurship, and as Max Chatsko knows, viral dances on TikTok. Those are the best ways we have to create wealth. We've got a few more of these. We'll take a couple of questions at the end of the show. We see a great one from Robbie. If anybody else has one, we appreciate you being along for this journey. Sam Bailey, our marketing director, our director of the show, thank you for putting this up. Lion says, buying my first new car with a long-term loan. The opportunity cost of those early years of debt repayment after accounting for compounding is, and he's got a skull emoji and another crossbones emoji. I'm going to take this one. If you are not a car person, so if you're not a person who owning the newest whatever is your prime source of joy in life, and I know a few people like that, and I don't lament them their car because they're willing to not live in as nice a place. But for me, a car is a way to get somewhere. I drive a used car. I have never owned a new car. I always buy a car that's a few years old, and I go get the consumer reports that tells me what the value is, and I find the best deal possible. That is the easiest way for the average person to save money. I know Matt Cochran drives a couple of old cars in his family. Simon, I know you want to get the 7 Investing Mobile, which will of course be a Tesla covered in 7s, but you aren't there yet. You're a family man. How do you approach buying a car?
Yeah, I mean, like it's all opportunity cost. It comes back to the question was about opportunity cost, right? There's nothing wrong with buying a sleek new car, but it's what's important to you. And then you kind of look back over 10 years of the life frame of a car. It's like, okay, could we have invested at something else? There's no right answer, no wrong answer for this. We don't typically buy brand new cars in our family either. That's just a personal preference, though.
Yeah, and again, there are people I know who buy a new car, but then keep it for 15 years. Like that's another way to sort of get the same value out of it. I don't think any of us don't do one of those. Now, again, I have a friend who just would rather sleep in his car than have a nice house. And that is totally understandable. So you got to look at your personal joy when making any of these decisions. We've got 2 more here. Sam, I thank you for being able to keep up with this. That is not easy. Ken Chestnut says using stop loss. Oh boy, Steve Simonton. Stop loss can sell you out of some really good stocks. Yeah. You don't even know it happened.
I know.
Why don't you explain what a stop loss is?
So stop loss is basically, and there's people who have like trailing stop losses where the stock will climb up and it'll kind of follow the price. And if the stock price goes down X%, or to a certain price, then it triggers an automatic sell order, right? And this is something like I don't use stop losses, and I'm sure there's people out there who can say, but I used a stop loss and it helped me avoid further losses in this stock. I'm not a day trader, and none of us are day traders, and that might work for some people, but it's extraordinarily unpredictable. And a lot of the stocks that I own, will fall regularly. They might plunge 15% and then rebound completely in the same day, and then you've sold out of all of your shares. And if you're a long-term investor, stop losses just shouldn't be a thing, because that's something that's very ineffective for my purposes. And I share. I don't share that regret, because I've never used stop losses, and I don't particularly care if a stock falls. Yeah.
And Max, as you know, I buy your recommendation every month to put more risk into my portfolio. If I had a stop loss, they'd sell like every 3rd day. Like some of the stocks you pick are biotech stocks, and there'll be a news story one way or the other that's immaterial to the long-term success of the company, but you'll see plus 20%, negative 30%. If you had a stop loss, it'd just be exhausting. This is something I would never, ever use. Max, I'll give you the last word in this segment here.
Yeah, for sure. I don't use them. Obviously, most of my portfolio is in drug developers, and they go up a lot or down a lot on no news at all, and they kind of just in between de-risking events. So, like, is there a big clinical data readout, or maybe a partnership, which you can never predict? So, if you panic or get too excited, that can be really bad. So, don't use the stop limit losses, that stuff, if you're invested in drug developers, for sure.
It is very important to note, and I come from the media world. I was a newspaper editor and writer for a lot of years. I worked at all sorts of different publications. If you have a newspaper, and I know newspapers are a thing of the past, but it applies to websites as well, you have a news hole you need to fill. It doesn't matter whether there's any news that day, and there's absolutely days where I'd be at MSN picking news stories to go on the MSN Money app, which is now not really a thing. And I would go, ugh, there's nothing good. So then you have to pick the best option. So you might be giving front page placement to something that 3 days ago wouldn't have made, the 5th story in your 17th most important channel based on the news that day. So as a consumer, you really, really need to consider whether news matters. And a lot of times when it's not a major event, Max refers to them as de-risking events in his space, but it's not something like the CEO left or the CFO got arrested for financial fraud. If it's not that kind of thing, it probably doesn't matter. We're going to take one last question here from Ravi Shah. I'm going to let Simon answer first, but if anyone else wants to weigh in, that would be great. Sam, if you want to pull that up. Ravi says, I feel scared to put all money in the stock market at this point since the market is at an all-time high, especially for someone who doesn't have positions built out. Wow, I understand the logic here, but Simon, that's actually not how I feel. And Ravi is a friend of the program and someone we really enjoy his participation. Your thoughts here, Simon?
I think it's interesting. We've kind of trained ourselves as investors to think about this as traders, right? We see stock charts all the time and we get scared when there's a graph and you see 12 months or 2 years or 3 years or whatever the time frame is, and it's at the top of the graph, right? We just kind of have a bias that we look at that and we say, oh, it's coming back down. I've seen that. I know what you're supposed to do. You buy low, you sell high. We've kind of, overall, we've gotten used to these price targets and, all-time highs being a negative connotation. But in reality, the stock market does not think about it like that. Companies do not think about the fact that their stock is selling at an all-time high. If they've got a good leader, someone who's going out there and developing and unlocking more and more value for shareholders over time. They're growing their revenue. They're unlocking new business opportunities. I mean, things like this. I think that my way to answer this is yes, there's no need to just dump all of your money in if you're a little gun shy. There's nothing wrong with waiting and seeing if you can get a better deal on a company that you're waiting for. But on the other hand, I have kicked myself many times on saying the same thing where I said, I'm going to wait until this stock sells off $5 a share, a couple of bucks a share, because I don't want to pay $20. I want to pay $18. And then, of course, you know what happens. It never falls. And then there's some really, really good results that happen. And then you end up buying at $50 a share. And each one of those was an all-time high along the way. And so a lot of companies that we'll recommend here at 7 Investing are selling at all-time highs at the moment we recommend them. And you might think that's crazy and say, well, why don't you wait for the dip? Why are you selling at the peak? It's because the market's always forward-looking. And if you see great performance, companies should be selling at all times high because that is the market giving a confirmation that they're doing things right. And one last point on this before I'd like to hand it off to somebody else who might want to speak on this as well, is an all-time high stock price is a huge benefit for a smart capital allocating manager. If you can go out and sell shares of an expensive stock and get the market to reward you with more money, you can do a lot of things that your competitors cannot do. Elon Musk has proven that true for years. Tesla is at an overvalued stock price that's been selling at an all-time high for a long time, and it continues to go up as he continues to unlock value.
I once had the belief that Tesla was facing liquidity crises because that was something reported on a lot. And a very strong financial mind told me they could just sell 10 billion worth of stock tomorrow. And that's actually what they did. They sold 5 billion worth of stock a couple of weeks after I had that conversation. It was like, oh, wait, yeah. Like you don't want to do that sometimes because it does dilute your stock price. But in the case of Tesla, it did not matter. This has been a very long show. This has been a very long day if you're a member. If you were a new member, you came to our new member call. regular members, and an awful lot of them came to our subscriber call. That's where we talk about our most recent picks, our highest conviction stocks. You have to be a member to go to those. And then, of course, we did this show. If you did not go to those calls and you're a member and you didn't get the invite, hit us up at info@7investing.com and we will correct that, or we'll at least let you know when to look for them. So email filters can be weird with any of that. But if you are not a member, what are you doing? That is 7investing.com/subscribe, $49 a month or $399 a year. $49 a month is a third the price of going to Disney World for a day. And you know what doesn't happen at Disney World? They don't give you stock picks that make you money. I've asked Goofy. Goofy runs a candy company, according to Disney, based on the gift shop there. And I've said, hey, Goofy, what should I invest in? And he doesn't talk. We give you our 7 best ideas. You can tell I'm getting a little bit punchy. Have not eaten today. I am in a hotel room. I'm going to correct that relatively soon. We thank so many of you for joining us today and joining us on this journey. Sam Bailey, let's get to the top rope. Let's hit our finisher. Which of the following themes are you most afraid of investing in right now due to the significant uncertainties about its future? Bitcoin, cryptocurrency, 33.8%. China, geopolitical, 47%. Cannabis, regulatory, 7.1%. Real estate / inflation, 12.1%. Simon Erickson, this was your Twitter poll when they're usually my Twitter poll. I'll let you have the first word here.
Oh, Max, please take the honors on this one. I know that China is someone that you followed for a long time. What do you think about that as winning the poll so far, China and regulatory?
I would agree. I've always been talking about, the U.S.-China relations are going to get worse. It doesn't, I was talking about this before the election, before I joined 7 Investing. Like, it doesn't matter who won the election. This is not going to be a great decade for U.S.-China relations. We're already starting to see that, right? And in different ways. I mean, China's been trying to target companies that are listing in the United States, and some of that's trying to get them to list domestically, whatnot. And so I would definitely agree. That's a really high percentage too. 47% agreed with me. So I'll take the victory lap here, guys.
Yeah, I think
Stephen, cryptocurrency, that was number 2 on the list. I know that we talk a lot about crypto and Bitcoin.
Right. I'm not that scared about investing in crypto because I don't mind volatility, but that's something you should expect. But yeah, it's I'd say China as well as would be the one that kind of makes me the most nervous because of kind of the review of the Thai review that they have, and the structure that all their companies, like U.S. listed Chinese companies, are going through, and there's a lot of nervousness for good reason there. So I would have voted that way.
Thank you, Karen, for your comment. Yeah, we totally understand. Part of why we're here at 7 Investing is to talk you through the angle of long-term investing. And we get it. When something looks like it's at an all-time high, you go, well, why would I want to buy in right now? But here's the reality. The all-time highs from like 1982 look silly now. So you really need to look at the overall market and recognize that if you're in this for 5, 10, 15, even as the oldest guy in the team, I'm in this for 20 plus more years before I would even think about putting my feet up and only working, 30 hours a week instead of, twice that or whatever it is we put in because we love this job so much. And we love all of you. Steve, weigh in. You're welcome to.
I would chime in on that as well to say, and her comment was that she appreciates Robbie's comment and question on investing in such high times and high valuations in the stock market making people nervous. That's not to say there's no chance of a stock market crash. It's not, but pullbacks in the market are much more common than you think. I think we average a 10% pullback once a year on average, correct? And bigger pullbacks once every couple of years. So that doesn't mean the stock market won't pull back, but the stock market can also rally a lot higher than most people think for a lot longer than you think. So we just tend to stay invested and think long term and not worry too much about that at any given point. So that's where we're coming from.
And this is a point I wanted to double click on too, which is the whole point of the poll of, these are risks that are really big risks out there that we shouldn't take lightly. I mean, like China, macroeconomic conditions in the US and China and the trade tensions, that's a really big deal, right? Real estate and inflation. I mean, that's going to have a direct correlation to asset prices and to equity prices, right? Bitcoin, what is Bitcoin going to mean for everything? I mean, these are big questions that we shouldn't just brush off and say, oh, it's nothing to be concerned about. But I think that the point of why I wanted to phrase in this question is when you've got institutions that are managing billions, if not tens of billions of their clients' money, they do tend to shirk away from things that have high risks. They don't want to get phone calls from clients saying, hey, sorry, we lost all your money. Now, as an individual investor, is that an opportunity we can take advantage of? I think that it is. And especially when there's sell-offs of great companies because of heightened risks, that's something that at least me as a growth style investor, I take special note of.
And Karen, we appreciate the comments. If you didn't see Wednesday's show, Anirban Mahante and I talked about the labor market. And look, we are in a period where labor has to figure it out. Wages are going higher. That's forcing prices higher. That's going to cause ripples all throughout the economy. That's not going to be simple. And yes, small towns aren't the stock market. They're disconnected. They experience things differently. Small businesses aren't the stock market. You and I aren't the stock market. So it's one of those things where you really need to look at the thing and understand what's happening. And here's the reality. You hear a lot about inflation. Inflation and price increases aren't the same. Remember when lumber was the number one story we talked about? Well, the price of lumber has fallen dramatically, partially because supply has increased and partially because demand has fallen. So there's just a lot of things you have to keep in mind. We cover them on this show. So if you go back through our archive and through the 7 Investing site, a lot of these questions are answered. But Wednesday's show with Anirban, which I was live in North Carolina, Anirban, we taped that segment with him in Australia. It is a ton of information there. We thank all of you for watching, for participating. There is a lot going on in the 7 Investing world today. If you have questions about your membership, about how to join, about our website, about Steve's baby back rib recipe, you can send those to info@7investing.com. If you'd like to interact with us, tag us on Twitter. That is @7investing. The one thing I love about FinTwit is it's the opposite of regular twit. It's not toxic. If somebody posts something toxic, they actually get shouted down by smart, interesting people. I can't say enough about how cool I think the people we interact with on Twitter are and how supportive they are. And if someone isn't like that, they're the one who gets kicked out of the room. It's like the opposite of high school. It's like the bully gets picked on as opposed to being the lead. Again, we thank all of you for watching today. For Matt, for Simon, for Max, for Steve, and of course, for Sam Bailey behind the glass. Thank you. We will see you Monday. In theory, I'll be back in West Palm Beach if all goes well. It is a very long trip. We'll see you then.